Hey everyone, recently CDSL has reported that they have opened 1 crore demat account in Q4 of FY24 itself and 3.26 crore demat account in FY24. This is unprecedented. Clearly the equity investment culture is picking up big time in India with a lot of new investors trying their luck in the stock market. Especially post-COVID, there's a huge surge in interest for the stock market. And there's one biggest reason. The exponential returns generated by Indian stock market, especially in the small cap and mid cap domain. For instance, small cap index has generated more than 200% return in last 5 years and mid cap index has generated nearly 200% return in the same period. Let me be very frank, majority of new investors have no clue about stock picking. In fact, I also had no clue when I started my investment journey. The only motive of a new investor is to make quick money, double their wealth in no time. But I always say that investment in stock market is not just about returns. You have to balance both your risk and returns. For instance, in last 1 year, SME companies and many micro-cap companies have generated humongous return for the investors. However, it comes at a risk. And this risk increases exponentially in case of SME and micro-cap companies. Today, when these SME and micro-cap companies are generating great returns, everyone is going gaga about them. But you need to understand that there are very few companies in SME and micro-cap space that are genuinely good. And it is very difficult to separate the wheat from the chaff. I still remember during 2018 to 20 period, everyone hated small cap and micro cap companies. It's because the small cap index was down 50% and many individual companies tanked 80 to 90%. During that period, everyone wanted to invest in top blue chip companies of India. However, tide has turned and today everyone wants to invest in only small cap and micro cap stocks and even SME companies because of crazy return that they have generated in last couple of years. Likewise, if you look at sectoral level, during COVID period, sectors like IT, pharma, chemicals were the darling of every investor because these sectors created humongous wealth during COVID period. But today the tide has turned. IT and chemical sector are the biggest losers, whereas hot themes today include your power, PSU, railway stocks, defense, capital goods, real estate, hotel. Many people invested in IT and chemical companies during their peak are still sitting on loss. Likewise, I'm sure sooner or later tide would again turn and many retail investors would get stuck in today's hot themes because market dynamics keep on changing frequently and what is hot today would doom and there will be new sectors that would become hot. In this process, some people would certainly make money, but history suggests that majority of retail investors would end up getting trapped at higher levels as they have no clue on fundamentals and valuation. They just look at past return that looks great and invest their money with the hope that they would get similar return in the future. This is a big mistake. Honestly speaking, stock investment is not that simple. It requires a good few years of knowledge and experience before you really start investing with conviction. But majority of retail investors have no experience and no time to learn. They want to make money now, which is very risky. By the way, this is not the first time when the market has seen such crazy interest. It happened during early 90s, early 2000, during 2005 to 8 boom, and of course, post-COVID. Every bull run attracts a new set of investors that unfortunately end up investing in hot companies of that period and majority of them end up losing money rather than making it. The only reason is lack of knowledge to identify fundamentally strong companies and inability to assess the valuation. Please note that I'm not trying to scare you. I'm trying to share the true picture of the stock market. Does it mean that you should not invest in stock market? No. In fact, I always say that India is bound to become the third largest economy in the world with GDP crossing $5 trillion and eventually $10 trillion. And in this journey, stock market will create huge wealth for its investor. However, if you want to benefit from this wealth creation opportunity, you need to build a portfolio that balances your risk and reward. And you need to control your emotion of fear and greed. So in today's video, I want to share my own investment strategy on how I build a balanced portfolio as a long-term fundamental investor. So personally, I also take advantage of hot themes, but I don't blindly invest all my money in hot themes. I'm sure you'll find this strategy useful. But again, this is only useful for long-term investors, not for traders. So basically, I've divided my portfolio into two buckets, core portfolio and satellite portfolio. Core portfolio includes stocks where I invest for more than 3 years. The goal is to invest in fundamentally strong companies that have a sustainable moat with bright growth prospect. So if there's a correction in my core portfolio, I don't panic. In fact, I utilize the opportunity to accumulate the stocks. My expectation from core portfolio is to fetch, let's say, around 18 to 20% kind of CAGR return over the long term. So 18% CAGR for next 10 years would give me 5 times return. At the same time, the volatility is low as compared to satellite portfolio. And my satellite portfolio include momentum stocks where I like to benefit from the upcycle in the industry. This is more of a short-term investment with less than 3 years of horizon. The expectation is to fetch high returns here. But I know that it comes at a risk. In fact, I did a video a few weeks ago in my weekly series where I shared my investment across core and satellite portfolio. So basically this weekly series has one exclusive video for my close community of long-term investors that you can explore on my website or via the join button on my YouTube channel. So my core portfolio include sectors like IT, banking and finance, auto and consumption theme. I know that these sectors have been wealth created in the last 40 years and would continue to create wealth. So IT, we are the leader in the world and future is digital. Banking and finance is the backbone of an economy. Auto, there is always a demand for two-wheeler and four-wheeler and there's a big shift from petrol, diesel to electric vehicle. So auto and auto ancillary is bound to do well. Then consumption is more of a theme that includes sectors like FMCG, retail, consumer durable sector. With more than 140 crore people and rising income and spending level, consumption is one of the top themes for next 20-30 years. Again, within the core portfolio, I like to keep my allocation across large, mid and small cap. And I make very little changes in this portfolio. Sometimes I do rebalancing and restructuring, but not very frequently. In fact, if you are a new investor and don't have a lot of knowledge for stock picking, you can also have Nifty 50 ETF or Nifty 50 index fund in your core portfolio. Then my satellite portfolio include hot sectors. For instance, today power is a hot theme, PSU is a hot theme. Then railway, defense, real estate, renewable, hotel, travel sector is hot. The only challenge is that majority of companies in this space gets overheated. So if you can identify this theme early and invest at a reasonable valuation, it can create good wealth. So valuation is a key here. And it's also very important to gauge how long the upcycle would continue. Again, this is very important. Ideally, you want to ride the wave for at least 1 to 2 years rather than ending up investing when the sector has already peaked out. And this is not an easy task, by the way. You need to study the con calls, keep a close eye on the latest development. Like I said earlier, during the upcycle, everything would look great. But eventually when the down cycle would start, many retail investors would get trapped. So it's very important to time your exit from satellite stocks. Hence, it is high risk, high reward segment. The next important question is, how much money should you allocate between core portfolio and satellite portfolio? Now, there's no perfect answer for this question. It all depends upon your individual risk appetite. But the catch here is that majority of new investors today only want to invest in hot themes because they want to double their wealth in no time. While it might make quick money in short term, this investment style is not sustainable in long term. You might fetch 100% return in a stock, but if the cycle turns and if you don't time your exit properly, that stock can fall more than 50% and you can end up with loss. And trust me, it's not that easy to time the exit. That's why as a long-term investor, you should always have a core portfolio that includes fundamentally strong companies with lower risk that you want to hold for very long term. And in fact, invest in SIP mode. And then you can always invest some money in hot themes to ride the wave. But like I said before, you need to spend a lot of time and energy to keep a close eye on the market cycle and valuation. Personally, I like to have around 75% allocation in my core portfolio and around 25% in satellite portfolio. I know that it is more tempting to have higher allocation in satellite portfolio where the stocks are growing exponentially, but it comes at a high risk of sharp correction when the cycle turns. And it's not that easy to time your exit. So it's not just about returns, but also about managing your risk. Always remember that. So this was about the strategy to build a stock portfolio across core and satellite portfolio. Please note that if you want to create wealth from stock market on a sustainable basis, then you have to learn how to do the fundamental analysis of a company and how to look at the valuation. Otherwise, every bull run attracts new investors, out of which many lose their money when the cycle turns. In fact, I've done a video on my 5-step framework on how to identify fundamentally strong companies. And also did a video on top themes to build SIP grade portfolio from scratch. So you need to understand that stock market is cyclical in nature and there will be ups and downs. Stock market will always test your patience, but if you invest with conviction with proper research, market will reward your conviction. One of the great examples from my own portfolio is Newgen Software. I invested in this company in 2021 during the IT sector upcycle. This stock did jump another 40-50% from my buying price, but it later tanked 50%. I did not lose my conviction and in fact accumulated it on fall. Eventually my conviction got rewarded, and today it is giving me more than 6 times returns. So make sure that you learn how to identify fundamentally strong companies and invest at fair valuation, and build a balanced portfolio for long-term wealth creation. And one last advice, while building your portfolio, always look at the bigger picture. Don't get stuck with short-term noise like your election and all of that. India's growth story is 100% intact. So this is it for this video. If you find it useful, do share it within your circle. I would see you in the next video. Till then, take care.